1.17, but it depends on where you put it, right? Sometimes it look like 1.952, so it depends, right? But it doesn't matter. That's your move. But this one looked more closer than the other one. 250 pips. So can you make it a swing? The answer is absolutely. You can make it a swing. You just have to know how to manage your trade, all right? And we show you that. Well, I talk about it all the time. So that's just my rule set. That's how I trade it.
Awesome. Okay, so now in regard to the 13, you said close the trade when it moves back above or below the 13 EMA. What time frame, 15 or H1?
It depends on when I take my trade. So for example, if here's my 4-hour chart, I exit when price closes above the 13 on the 4-hour. If I'm taking on the 1-hour chart, my execution is on the 1-hour chart. I got to manage the trade on the 1-hour chart. Close above the 13 on the 1-hour chart, I'm out. Whichever time frame I'm managing the trade on, whichever time frame I'm executing the trade on.
Cool. Yeah, we got a bunch of people asking about what's up with the harmonic indicator. Can you please share that? Can you please share TDI? What do you say to that? I talked about this last night. We obviously can't. Those are proprietary. Those are for members only. It's not part of the open house distribution.
Absolutely.
But I figured maybe you'd like to chime in as well.
Yeah, no, absolutely. I mean, listen, everybody wants to trade and wants to make money, right? The key piece of all of that that's really, really missing is education. And you got to get the right education, man. You have to know. And it's an investment in yourself, right? So you got to invest in yourself. I mean, it's a tool that Steve gave us, and it's a tool that you will get once you're part of the family. I mean, that's what that is. It's just to be fair to those people who are in the group, right?
Absolutely. What pairs do you recommend for BTMN, like for trading the method?
Euro and pound crosses, man. That's it. Don't look at all the other pairs. They're too slow, and unless you're trading 1-to-1, you can trade this like Aussie and Aussie yen and stuff like that, lower ADR pair, but you got to go 1-to-1 risk reward. That's it. Because they turn back and they're going to stop you at a break even more often than you can count. All right. So what are you doing? You're just giving commission and fees to the brokers. That's all you're doing. You're not really making any money because they'll turn around and take that money right back. So you got to go 1-to-1. So if you have I know it's kind of funny, right? If you have 8 or 10 pips stop, you're going for 10 pips. I mean, that's almost scalping, but that's how you would have to trade it. Again, if you're trading percentage of account, it really won't matter, because if you're going 2% and in 10 pips you're making 2%, who cares?
Yeah, absolutely. Now, as a beginner, Steve always said, look, you're starting off, you're learning the method, pick 4 pairs. What would be the 4 pairs that you would tell people to trade?
Okay, great. So I would go EU, EJ, and then GU and GJ. That's it. That's what I would go. And you're trading a major and you're trading 2 majors and 2 crosses. I wouldn't recommend like.
All right, cool.
CADs, because CADs would be it's an opposite, right? So it kind of works a little bit funky. And GA and GN or EA and EN, the spreads are too big in most cases, right? And GF is also opposite, right? So your best bet is GU and GJ and EU and EJ.
All right, cool. Let's see. What was the where was the percent script? That's also a BTMM thing. So we can pass that. On the ID move, must the pullback always be 25 pips to the water?
On an ID move, the pullback has to be 25 to 50 pips back to the water. That's an ideal situation. Lower ADR pairs will not pull back 25 to 50 pips. Some of them will pull back 20 pips. All right, because if an ADR is only 60 pips, right? Think about it. If an ADR is only 60 pips, right, and there's 3 pushes within that 60 pips, each push is only 20 pips, right? If they move 20 pips, they're not going to pull back 20 pips. If they pull back 20 pips, it becomes an M, right? M structure. So it's going to pull back a lot less maybe 50% of that pullback. Sometimes 61.8 fib. That's where the pullback comes in. So for those people who are trading using fibs and stuff like that, right? Your best bet is the pullback is going to happen after the structure. So if here's my structure, you start from the second leg, right? And then you see the pullback coming back to 50% of the pullback, and then it drops from here. Not to put a pending there, but I'm just saying, if you're calculating that using the pullback, then the pullback does not necessarily have to be 25 pips. It can be a little bit less based on your ADR.
Okay, cool. Now, I actually want to backtrack. I answered one of the questions, but I want you to tackle this as well, because it turns out I answered it incorrectly. Okay, so for everybody, somebody asked, each level box equals the ADR value, ? And I was spending a lot of time answering questions, and I was also handling some email and people trying to get in. So I actually wasn't watching the screen as much. And I answered that the boxes are actually the consolidation zones. And I talked about how the market is dynamic. So level 1 could be 75%. Level 2 could be 125%, and anywhere in between and beyond, right? So what I didn't notice is, back in the day, Carr was more the pioneer. He was mainly the pioneer of how levels were drawn. And Carr used to strictly draw around the consolidation levels. But now I'm looking at your chart, I'm going, oh, you know what? Now you're drawing boxes that connect, and they encompass the entire move. So why don't you talk a little bit more about what you look at on the chart and how you decide to draw the boxes?
Very good question, right? So if you look at this move coming up, right? So this, let's look at from here, GC, right? So for example, from here to here, right, from the bottom to this top here, it's about 390 pips, right? Close enough to 3 times ADR. It's more than 2, less than 3. Let's put it that way, right? So it's let's say 150. So 2 times ADR would be 300. And this is about 390. So it's a little bit more than 2, little less than 3 times ADR, but it's more than 2. So it's in 3, but not 3 times ADR, okay? So that's why this looks a little scrunched. So if you look at this move from here to here, the straight up move is about 260 pips, almost 300 pips. So this is almost 2 times ADR. But again, for visual purposes, here's my consolidation, here's my consolidation, here's my consolidation. So this box was drawn for visual purposes, right? I could have purely, like before, I could have purely removed that box and done this. Move this out of the way, put this as 2, and leave this as 3, and then you're like, wait, how did it go from 3 to 2 to 3? Because the move from here, up here, was almost 2 times ADR, right? Again, for visual purposes, I did it the other way around, but this is the correct way to draw it. 50-200 cross, W off the mail, right? 60 pips, easy. 1350 cross, first pullback, 50-50 bounce, right? Now, of course, this was news candle, so you can't take this trade, right? So if you look, 1350 cross is the easiest thing to see. 1350 cross is level 1. Then when it takes out this high, notice level 3, because it came off 1 ADR. When it goes 1 ADR up, this should line up with 3. The 1 should line up with 3, like that, right? And then once it takes out this level 3 area, now you're in 2. If you measure from here to here, it's about 300 pips, which is 2 times ADR. So you're in level 2. As far as I'm concerned, as long as it stays above this area, I'm in 2. And then once price breaks above this, now I'm in 3. So if I measure from here down here, I'm approximately 400 pips, which is, I'm in level 3, just not 3 times ADR. I'm looking for shorts. Over here, I'm looking for long, W of the Mayo, right? Level 2, W of the Mayo. That's what